Well, actually, we crunched the numbers for this year's In Gold We Trust report, where we made a case for a recession to start in Q4. And it can still happen, obviously, but what is important, we said, well, actually, every recession has a couple of different stages. And then we crunched the numbers and calculated which asset class does best in which stage of a recession.
We're talking to one of the experts on macro and gold, Ronald-Peter Stoeferle. He is a fund manager of Incrementum and also the author of the In Gold We Trust report, a very comprehensive report that comes out, I believe, annually that discusses not just gold, but all the macro forces driving the gold market that all investors need to understand. Whether or not you're invested in gold is irrelevant because this covers everything. Pleasure to host you, Ronald.
Thanks, David. Thanks for having me. And yeah, first of all, congratulations
Thank you.
on being self-employed now.
Yes.
Yeah, it seems you're extremely successful and yeah, well-deserved.
Thank you. It was a risky move going into what many call for a recession. But you know, I like taking risks. Let's start with talking about a recession because, you know, earlier in the year when I launched my new channel, a lot of people were calling for a recession. It seems that some people have changed their stance, pushing back the recession call when earlier in the year people were calling for a recession to hit by 2023. Now they're pushing it back to 2024. A lot of Wall Street firms certainly are doing that. Is that your view that we're getting a recession by 2024?
Yeah, well, I mean, we've been too early with our recession call, as many others, Dave Rosenberg, for example, and so many others. But that, I think that the narrative or the view in markets clearly changed in the last couple of months. So we basically went from hard landing to soft landing to no landing, and now we're like in Goldilocks. And if you have a look at GDP now for Q3, it's now at 5.9%. And I think, David, what's also important is that basically the FOMC has been telling us that they will keep rates higher for longer, but absolutely nobody believed it. So the big change in markets over the past few months is that now actually the market really believes in the Federal Reserve to stay higher for longer. So we have all been in this kind of bailout Bernanke mode for quite a while, and Powell, we have to give credit to him. He kind of changed that, and he maintained a hard line and being tough on inflation. So this is definitely something that I didn't see coming. However, if we have a look at the consequences of this rate hike cycle, basically the most aggressive rate hike cycle since the 1980s, I think it's pretty obvious that we're clearly moving into a recessionary environment, that we are late cycle. Just a couple of facts. I mean, if you have a look at the PMIs, for example, each G7 nation, along with China, Australia, and all of Europe, has a contracting PMI. If we have a look at the ISM manufacturing for August, it was 47.6, I think. It was slightly higher than expected. But still, we're seeing for 10 months in a row a contraction in industrial activity. We can talk about the yield curve forever. We can talk about the leading economic indicator. So therefore, I think that the longer actually the Federal Reserve feels that their moves on the rate side as well as quantitative tightening, which is something that very few people talk about, even though it's draining like $1 trillion out of the market at the moment. I think the longer they feel that it just works well, the longer they will continue with that policy, and the clearer and the more obvious the recession call will become going forward. So clearly, I think 2022 has been the year of inflation, 2023 is kind of a transition year going back and forth. And 2024 will be a year where I think the recession will be the most important driver for markets.
One of the slides in your chart book called Inflation Heat Map. Now you have, this is slide 36, you have the inflation heat map for developed markets, for emerging markets. I'm looking specifically at the United States now. All across the map, except for a few exceptions like PPI and U.S. import prices, all across the map is red, which means it's still hot, relatively speaking. The core PCE, which is the Fed's preferred measure of inflation, is still above 4%, so still red. Twice the level they're looking for, Ronald. My first question regarding inflation is what the Fed is going to do to continue fighting inflation. Are they going to raise rates more, or do you think keeping rates elevated will be sufficient?
Well, I think that this is kind of the major concern for Jay Powell, obviously at the moment. So I think quite recently the doves have become somewhat louder and more vocal. But still, Powell, I think he still wants to continue raising rates, and we always said that this U-turn, this pivot will be different than previous ones where inflation wasn't an issue at all. So it starts with smaller hikes, then there will be a pause, and then they will panic and start lowering rates. And I think that now markets think that in November will be the next hike. I'm not so sure about that, because it seems that inflation rates have put in a temporary low. If we look at energy, for example, I mean, it's I think crude oil just made a new high for this year, and it looks like a very impulsive move. If we have a look at the Cleveland Fed inflation nowcasting, we see 3.8 for September, with core CPI at 4.3%. So it seems that that clearly inflation is much stickier than the Federal Reserve wants it to have. Therefore, I would say that we will probably see a Federal Reserve that will try to appear more and more hawkish to kill inflation. But actually, as we all know, the recessions are probably the way to go, the way to significantly reduce inflation rates. Every recession is disinflationary. So I think in the labor market, we have already seen last Friday's report was very weak, especially the revisions. So from my point of view, we are clearly moving into that direction. But I have to be somewhat critical of my timing. We've been too early, and it takes longer. But if you have a look, I mean, it's not just in the data, but also if you talk to business owners, if you talk to investors, if you talk to real estate development companies, well, actually, the outlook over here in Europe and I think it's probably quite similar in the United States is a very negative one. And I think we all experience now how this lag effect, this time lag, from what we once called the tequila theory of money, how long it really takes that those rate hikes really translate and actually arrive in our economies. I think this is now really starting to be felt. So therefore, I think, as I've said, inflation numbers should come down. They are sticky due to structural forces that we described in our previous reports. Obviously, labor costs are a big driver. This inflationary mindset that we are moving into, where people just expect inflation rates to be way higher than previously going forward. I think this is a major driver for inflation going forward. But still, I think that a recession is clearly disinflationary. So I think numbers should come down.
If we take a look at the market performances of stocks, gold, they've both moved relatively up this year compared to last year. Is there a reason for why everything, risk assets and supposedly safe haven assets, have all moved up this year despite monetary tightening, despite higher Fed funds rate? Usually they move in tandem when the Fed eases. That happened in 2020, but this year both moved up. Do you have a theory as to why?
Well, I mean, I could come up with good reasoning, and afterwards we're always extremely smart explaining a development in markets. But year to date, I think we're up like 6% in dollar terms. We just made a new all-time high in Japanese yen terms. Gold is up 19% in yen terms. In Canadian dollars, gold is up 6%. In Aussie dollar terms, gold is up 12%. And I think what's fascinating, David, is the fact that actually people couldn't care less about gold, especially the investment crowd. If you have a look at ETFs, for example, and they are, from my point of view, the marginal investor in the gold space. You can see that we're actually seeing outflows coming from professional investors. Now, I think what's compensating this behavior is, first of all, central bank demand. As we know, last year saw an all-time high in central bank demand for gold. And also the first half of this year is pretty strong. I think the strongest year since the year 2000. So central banks from all over the globe, of course, from BRICS nations, from emerging markets in general, but also from Poland recently, from Hungary and Singapore, they continue buying gold for geopolitical, geostrategic reasons. I think that's one important explanation. And then I think the second one is that actually, this huge divergence between real rates and the price of gold, we always had a very, very tight correlation. And it seems that gold is already kind of calling BS on the rate hikes. And to be honest, if you would have told me, Ronnie, well, what's your view? Real rates go to plus 2%. Where's the price of gold gonna be? I would have said probably like 1600s, 1700s. But my interpretation would be now that this is actually a sign of strength. And this is probably the chart that I'm following most closely at the moment. The yield curve, and how does the 10 years and the 2 years technically behave at the moment. And I have to say, last Friday, when this very weak jobs report came in, the price action in the bond market was pretty concerning from my point of view. I would have expected yields to fall big time after such a weak jobs report. So one reason obviously can be that it's the treasury supply overhang. I mean, we're seeing basically full employment. The US has a budget deficit of, I think the last 12 months, like 8.5, 8.6%. And such a level of budget deficits usually happens during recessions. I think over the GFC, we had like 10% budget deficit, but not when you've got full employment. So I think that could be one reason. And then the second reason probably is that we're seeing major portfolio shifts happening. I think that people kind of realize that perhaps in this structurally higher inflation environment, bonds, and especially treasury bonds, aren't the safe haven asset anymore, and we're actually seeing some sort of a bear market in safe havens. There's not too many left, and this is probably one of the reasons why the price of gold is developing so well. So long story short, I think once we see a turnaround in yields, We had a brilliant chart in our last In Gold We Trust report where we showed that every time when the 2 years actually started trending down, that was most of the time the point when gold started a big bull market. So now we are on pretty lofty levels, as we know. I mean, the 10 years are at 4.3%. The 2 years are at 4.9%. So those are huge opportunity costs for gold. And as I've said, the fact that the price of gold is holding up so well in this pretty challenging environment, that's for me a sign of strength, a sign that there's lots of demand actually, and this demand is coming primarily from central banks.
In your introduction to the newest In Gold We Trust report that came out in May, you wrote that, well, first of all, you cited a quote from an earlier report, and I'll just read it. The balancing act of fighting inflation without triggering distortions on the markets is doomed to failure. The vehemence of the tightening cycle that has begun threatens to end the everything bubble in an everything crash. I think that summarizes the thesis quite well, Ronald. Why will we get an everything crash is my question.
Yeah, as I've said, I think if you're looking below the surface, there's so many signs with a really good track record. Yeah, the yield curve, although economists and especially the Federal Reserve, every time the yield curve inverts, they tell us, well, this time it's different. Of course, it's not. The leading economic indicator has been really accurate calling recessions. Then, as I've said, job numbers are coming in weaker and weaker. But I think one thing that we have not really seen yet is signs of stress. First of all, in the credit markets, holding up pretty well still. And I think equity markets are also holding up fairly well this year. We're seeing some sort of investors' complacency. The VIX is trading at 15 now or something like that. But I think it's kind of a reaction, kind of a mean reversion reaction to last year. So actually, we still have pretty similar developments or problems or issues like in 2022, and we're now seeing again that only a handful of sectors are at new highs, and most of them are not cyclical. And we know, as Bob Farrell famously said, markets are strongest when they are broad, and when they're weakest when they're narrow to only a handful of names. And we know that, in 2015, for example, only 2 of the top 10 S&P stocks were tech stocks. Now 7 are tech stocks. We know that the concentration is an issue. So from my point of view, I don't really have to enter those crowded trades in the tech space. Everybody is talking about AI stocks. Everybody's crazy about Nvidia. But if you are in love with those stocks and can't part with them, then at least spend this year selling call options or putting in limits. So I think the equity markets, I'm seeing tremendous value in some of the old economy stocks. I think we're seeing decent valuations there, but those everybody darling stocks, those island stocks, still are overvalued as ever. In the bond market, as I've said, this year could be the 3rd down year in a row. I think Michael Hartnett at Bank of America put out a chart that this hasn't happened since the year 1787 or something like that. So treasuries being down 3 years in a row, that's pretty historic. And it also shows, David, that there's a regime shift happening. And I think this regime shift clearly has to do with inflation. It tells me that the great moderation is over. It tells me that we should be preparing for structurally higher inflation rates. And let's face it, this is exactly what central bankers always wanted to achieve. We kept hearing inflation rates are too low. We have to do more. We have to be more active. We have to lower rates. We have to do more QE. But I think the most powerful thing, and this is something that we described in our 2021 report called Monetary Climate Change. It is the fact that fiscal policy has taken over. We're seeing some sort of a MMT style policy now. And of course, the time sensitivity of money printing is vastly different. So fiscal deficits are fast money creation, and credit tightening is kind of a slow money. So I think over the COVID crisis, politicians kind of learned that, handing out government subsidies and government checks and doing fiscal spending, this actually works, and it helps at elections. So I think that's something that I said quite often previously. We should all be focusing less on what the Federal Reserve and central banks are saying and especially doing, and focus more on what politicians are doing. And this year, there were three major things that actually impacted the economy this year. First of all, we saw that Social Security Administration, they announced a roughly 9% increase in benefits, which was the largest cost of living adjustment in 41 years. So that was clearly a big thing. The second thing was kind of a hidden stimulus when they announced that the tax brackets are raised by 7.1%. Vincent Deloitte did some great work on that and showed actually what tremendous impact that has on consumers. And the third part of this stimulus was basically the Inflation Reduction Act that was obviously announced already last summer, but now it is really kicking in. So those three measures that were, from my point of view, responsible for this surge in economic activity this year, but they're all kind of fading out over the next couple of months, which improves my recession case. And the next thing that's probably also important is, I think, the Fitch downgrade, it has an impact. It has an impact. It's kind of a sign. Okay, well, we should probably, not be too loose on the fiscal side. So therefore, I think this fiscal stimulus will kind of fade out and meet with this enormous rate hike cycle, which is a recipe for recession from my point of view.
You have an excellent chart here showing the heat map of commodities. This is also from your slide deck, slide 37, monthly performance of various commodities. Oil has done well between 2021 to 2023 and outperforming some of the other base metals. Looking forward, though, Ronald, let's assume that your recession outlook or thesis is correct. Which of these commodities on this heat map are most likely to outperform during a recession, and which will underperform?
Well, actually, we crunched the numbers for this year's In Gold We Trust report, where we made a case for a recession to start in Q4. And it can still happen, obviously, but what is important, we said, well, actually, every recession has a couple of different stages. And then we crunched the numbers and calculated which asset class does best in which stage of a recession. Actually, gold is a pretty decent recession hedge. On average, gold is up 10.8% during a recession. When it comes to silver, if you believe in a recession, be cautious on silver. The same goes for commodities in general. They only start profiting once this reflation phase really kicks in. So So this is normally the time, like the darkest hours of a recession, when everybody is getting super, super bearish. And this is usually also the time when central bankers and politicians start panicking and introduce, first of all, monetary, but also fiscal stimulus. So this is the point when you should aggressively start buying silver, start buying commodities again, but we're not there yet. We're clearly not there yet. Therefore, I remain somewhat cautious in the commodity space. When it comes to energy, I think one point obviously is, as we've seen today with the production cuts by Saudi Arabia and Russia, it is highly political at the moment, even more political than usually. But then I think for commodities in general, quite an important driver will probably be on the supply side. And I think those drivers could be even more important than the falling demand that usually happens over the course of a recession. So this capex cycle, this underinvestment that we've seen over the previous bear markets. We described that in this year's In Gold We Trust report. I think that's a very, very powerful argument to be made for commodities. I mean, we do consume roughly 40% more commodities than 15 years ago, and capex levels are at a 15-year low currently. I think many politicians kind of woke up last year and realized that commodities aren't something bad, something dirty, but actually they're quite important for our industrial activities. So I'm seeing quite a lot of development. There were really good reports coming out from the US Energy Department regarding the critical minerals. And there's more and more happening, but it takes time. So I would say further weakness in the commodity space over the next couple of weeks, next couple of months, probably, as we're seeing more and more recessionary pressure. But this could really be some sort of a once-in-a-lifetime opportunity. As the fiscal stimulus and the monetary stimulus kicks in when this reflation phase starts, and then in combination with this lack of capex in the previous cycle, I think that's a very, very powerful setup for commodities.
Let's just talk about gold for just a minute. Do you see a scenario in which we get a slowdown in the economic growth, like a recession, for example, and at the same time lower inflation because of the recession? So we've got a recession and lower inflation. Historically, recessions have been coupled with lower inflation. What will happen to gold in that scenario, keeping in mind that gold has responded well to inflation in the past, but also responded well to recessions?
Well, that I think we combine that in our analysis, and as I've said, recessions usually go hand in hand with falling inflation rates. We did the same analysis for stagflations. And actually, I think we are in a stagflation. I mean, Germany, for example, is officially in a recession now, and we're seeing inflation rates obviously coming down, but still at 6, 7, 8% over here in Europe. So stagflation is clearly what's happening over here. Stagflations are pretty tricky to analyze because there's not too much history besides the 1970s, and they were, of course, there was a tremendous bull market in gold, and also the two oil shocks. But I think that scenario with the recession and inflation rates coming down would be an okay scenario for gold. I think the worst case scenario would clearly be the soft landing, the Goldilocks scenario. So this kind of soft landing that the market is kind of discounting at the moment, I think this would be the worst environment for gold going forward.
Would you say that $2,000 or just above, which is what we saw earlier this year, would be a fair value for gold given the factors we discussed, assuming no major changes in the economy?
Well, actually, I think that if we have seen the highs for let's say for this cycle in yields, then I think we can trade up to 2,200, 2,300 over the next couple of months. Clearly, I'm not 100% sure. I think from a technical point of view, it looks like we will make a lower high for the 10-year yields. It already looks kind of overbought. Perhaps we'll make some sort of a breakout, but I don't think that we will, on a sustained basis, really take out the high in yields that we saw in October of last year. And I think if we see a larger move lower, that would be a tremendous tailwind for gold. And then, as I've said, we can quickly go to 22, 2,300. And actually, the fact that investors, as I've said before, if you have a look at ETF demand, investors couldn't care less about gold, even though we're not too far away from new all-time highs, also in US dollar terms. I think that's a pretty good setup. On the other hand, if I have a look at the US dollar, I'm not so sure. It seems like it's kind of bottoming at the moment. But then also, if the Federal Reserve is the first to start pivoting, then probably we'll see a lower US dollar. So as I've said, it's going to be a pretty interesting development over the next couple of months. And we haven't talked about geopolitics and what's going on in the BRICS world and in the energy world and so on. It should be a pretty constructive setup for the price of gold.
According to the World Gold Council, their data shows that central banks have been net sellers of gold earlier this year and now are returning to net buying again as of June. Do you think, generally speaking, I'm just in general terms, do you think central bank buying of gold could be a leading indicator of the price, meaning that they are price sensitive and they buy when they believe it's undervalued?
No, not really. Those are, people running central banks are bureaucrats, and there's they don't work, or let's put it that way, they don't make decisions based on daily price moves, and I think they've got they discuss long-term plans, purchasing plans, and then they stick to them. But what's really interesting is first of all, I think the whole BRICS discussion, gold-backed currency, and so on that will be announced. We always said that's don't believe what the Russian embassy in Kenya is tweeting out. But of course, I mean, what's going on in the bigger picture? It's those are significant steps that the BRICS now welcome, Saudi Arabia, Argentina, Egypt, Ethiopia, Iran, and the United Arab Emirates, especially when it comes to the energy market. Those countries will be responsible for roughly 50% of global oil exports. So I think, those trends, I don't know if we want to call it de-dollarization, or just emerging markets becoming a little bit more vocal, a little bit more self-confident, also because of their clearly growing economic confidence. I think that gold plays a major role in that game. And those countries, the emerging markets on general, they hold 54% of FX reserves. And the majority of them is obviously in US dollar terms. And therefore, I think, as we've seen last year with the sanctions against Russia, with the stroke of a pen, 300 billion can be wiped out. And this is kind of that was a pretty important lesson for many other countries. Saying, well, we have to diversify out of our US dollar holdings, and we need an asset that doesn't have any counterparty risk, that is traded 24/7, that cannot be inflated at will. And therefore, I think it's this trend of central bank buying will be one of the pillars of the upcoming gold bull market.
Excellent. Well, I thoroughly enjoyed not just interviewing you today, but also reading your report in Gold We Trust. Very thorough report. Again, we didn't have time to cover all, I think, 300 pages or something. It was a very thorough book. 400 pages. I underestimated. Where can people follow your work? Where can we learn more from you?
Well, we're publishing the Gold We Trust report since 2007 already. You can download it totally for free at our webpage, ingoldwetrust.report, in German, in English, in Spanish for the compact version, and also in Mandarin. But then primarily we're asset managers based in Liechtenstein. Have a look at our company webpage, incrementum.li. We are investment boutique managing funds, primarily, I would say, in real assets, commodities, of course, gold and silver. Bitcoin also plays a major role in some of the funds. And then I'm also pretty active on Twitter. I tweet out, lots of charts, but also, it's probably not too interesting for most of your audience. Comments on Austrian soccer. That's just my passion. So Ron Stoeferle, that's me on Twitter.
Okay. We'll get your World Cup predictions next time. That would be a next cycle. But excellent, Ronnie. I appreciate your time today. And next time we'll have you on and talk more about Bitcoin. We didn't have time today, but there was a very excellent overview of the macro and gold and commodities situation. We'll put the links down below. Make sure to follow Incrementum's work in those links. Thank you very much again. Thank you.
David, thank you very much. As always, a pleasure. Take care, my friend. Bye.
Yes, and thank you for watching. Don't forget to subscribe.